What is the price to earnings ratio? The price to earnings ratio, also called the PE ratio, is the ratio for valuing a company that measures its current share price relative to its per share earnings. The price earnings ratio is also sometimes known as the price multiple or the earnings multiple. The PE ratio can be calculated as market value per share divided by the earnings per share. So, breaking down the price to earnings ratio. In essence, the price to earnings ratio indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of that company's earnings. This is why the PE is sometimes referred to as the price multiple, because it shows how much investors are willing to pay per dollar of earnings. If a company were currently trading at a multiple PE of 20, the interpretation is that an investor is willing to pay $20 for $1 of current earnings. To calculate the PE ratio, the earnings per share, or also EPS, must be known. EPS is most often derived from the last 4 quarters. This form of the price to earnings ratio is called trailing PE, which may be calculated by subtracting a company's share value at the beginning of the 12-month period from its value at the period's end, adjusting for stock splits if there have been any. Sometimes price to earnings can also be taken from analysts' estimates of earnings expected during the next 4 quarters. This form of price to earnings is called a projected or forward PE. A third, less common variation uses the sum of the last 2 actual quarters and the estimates of the next 2 quarters. Now let's calculate the PE ratio for Walmart stores. As of November 14, 2017, when the company's stock price closed at $91.09, the company's profit for the fiscal year ended on January 31st, 2017, and this was 13.6 billion. And its number of shares outstanding at that time was 3.1 billion. Its EPS can be calculated by taking the 13.6 billion and then dividing it by the 3.1 billion shares outstanding. This will give you a EPS or earnings per share of 4.40. Walmart's PE ratio therefore is $91.09 divided by $4.40 is 20.7. You can track the PE ratio for the stocks in your portfolio or individual stocks by adding them to your own watch list. Here we list the top and bottom 3 companies in the S&P 500 by PE ratio. The list updates daily based upon movements in the stock prices. So adding stocks you are interested in to your watch list is the best way to keep an eye on them. In general, a high PE suggests that investors are expecting higher earnings growth in the future compared to companies with a lower PE. A low PE can indicate either that a company may currently be undervalued or that the company is doing exceptionally well relative to its past trends. When a company has no earnings or is posting losses, in both cases, PE will be expressed as not applicable. Though it's possible to calculate a negative PE, this is not really common. The price to earnings ratio can also be seen as a means of standardizing the value of $1 of earnings throughout the stock market. In theory, by taking the median of PE ratios over a period of several years, one could formulate something of a standardized PE ratio, which could then be seen as a benchmark and used to indicate whether or not a stock is worth buying. There are also some limitations to the PE ratio though. Like any other fundamental designed to inform investors as to whether or not a stock is worth buying, the price to earnings ratio comes with a few important limitations that are important to take into account. as investors may often be led to believe that there is one single metric that will provide complete insight into an investment decision, which is, of course, never the case. One primary limitation of using PE ratios emerges when comparing PE ratios of different companies. Valuations and growth rates of companies may often vary wildly between sectors, due both to the differing ways companies earn money and to the differing timelines during which companies earn that money. As such, one should only use PE as a comparative tool when considering companies within the same sector, as this kind of comparison is the only kind that will yield productive insight. Comparing the PE ratios of telecommunications company and an energy company, for example, may lead one to believe that one is clearly the superior investment, but this is not a reliable assumption. So guys, I hope you liked this video. If you have any questions or comments, just leave them in the comment section. Don't forget to like this video and subscribe to my page. I'll talk to you in the next video.